Well, hello everybody. We are going live in 1 second. I'm going to switch over real quick. I don't know why it's not doing this. Okay, well, we're going to skip that little section part and just say hello to everybody. So we are live on our Facebook stream, and we are talking to a lender today. So I know we've had Trisha on before, and we've talked about different pieces of purchasing the house. So today we're going to talk about a lender's perspective of what is important if you are ready to buy a house. So you've saved your money, you're ready to buy a house. What do you need to do? What's the next step? So we're going to go ahead and talk to Trisha Brant and kind of get some of these answers to some of these questions. Trisha, you want to say hi and introduce yourself real quick to everyone?
Yeah, hey everyone. I'm really happy to be back. I work for Fairway Independent Mortgage. We're one of the nation's largest mortgage lenders. So we have a really great reputation in the industry. You know, we're known for customer service and competitive rates, and we have several loan options to offer our clients. And I'm just excited to be here to share the knowledge with you all.
It's great. It's great. So Trisha and I partner up a lot, and we have a lot of clients that will utilize her services. She's got great communication. She's helped a lot of our clients. So I thought it would be a great perspective to have from Trisha. So you're ready to buy a house. What do you do? What's your first step? And how do you actually know that you, not in your mind mentally, are ready to purchase a house, but your financials and whatnot? So Trisha, let's go ahead and go through some of the quick steps of what does a prospective buyer need to go through? What do they need to do first?
So I feel like, you know, just knowing whether or not you're financially ready is something you're going to want to take. There's quite a few things you're going to want to take a look at, actually. So the first one would just be, survey your current finances. Sorry, that's my dog back there. Survey your current finances.
That's okay. We're all working from home these days.
Yeah. And I'm dog sitting too, so I have a crate behind me.
Okay.
I've got a lot going on back there.
Yeah.
But the biggest thing you're going to want to take a look at is your credit profile. So one of the biggest things that you're going to want to check in is what is your current score. So there is a difference in your score as far as your FICO and your mortgage score. So just know your mortgage score is going to be weighed a little bit heavier.
So how do they do that? How do they find out their mortgage score?
Realistically, it's when you're ready to move forward and the lender pulls your credit. So a regular FICO score it's based off of a different algorithm. It's kind of newer technology, whereas the mortgage industry is still stuck with the original, algorithm. So just what I'd like to say is whatever your middle score is on there, just know that your mortgage score will be slightly lower than that. And it doesn't mean that your FICO score is lower. It just means it's way heavier just because it's a larger loan and it's more risk.
And when you said that your middle score, and you're referring to the three different credit bureaus.
Yes, yeah. So your TransUnion, your Equifax, and your Experian scores are where you'll be able to find yours. Typically, we send, you can do this through the actual bureaus. So you can go to each of them and get a free score every year. Some people I believe it's annualcreditreport.com. It kind of combines everything. You get your full report. There's a couple of different resources. It can vary. You can also pay for services, and they'll provide that to you as well.
Mm-hmm, mm-hmm. Okay, good. Just want to make sure we kind of covered that real quick. So because people are always asking about that particular question. So I'm glad you covered that.
Yeah, and I think so. You're going to want to know that different loan programs also require a minimum score. So, like typically right now, most lenders are requiring 620. I know VA and FHA is around a 600, and then any jumbo loans are going to vary by provider. So every lender can go with a minimum for the guidelines, but can also put an overlay on the score. So sometimes you'll go to a lender and they'll say, oh, our minimum score is 650. And you may not meet that. just know that it's because they have an extra overlay on it. So maybe, you know, a typical lender will have it at 620, but this particular one is requiring a 650. So it's just, it's going to vary.
So really, even in the sixes, 620 to 650, someone can still purchase a house.
Yes, absolutely.
Yes.
And prior to COVID, it was 580 was the minimum. So COVID has just caused a lot of, you know, investors to kind of be more conservative, just because there's a lot of foreclosures happening because of unemployment and things along those lines. But we're starting to see some of that unravel now.
Nice, nice. So loosening up a little bit.
Exactly. So you're going to want to check your score, but the other thing that you're going to want to check is if you have any collections on your account, any derogatory accounts. If it's an older account, let's say it's an older collection that hasn't been paid, typically you may not necessarily see that that's an issue. But if you have multiple layers of risk, let's say you have, you know, a collection as well as a derogatory account, as well as a lower credit score, then you may not qualify just based off of the full, you know, perspective of your credit. So those are things you're going to want to look at and take care of.
So here's a real quick question on this. I just read this on somebody else's Facebook page that I reposted onto mine. There was some old data that was still on someone's credit report. So I'm wondering, even if that were to be the example for somebody, that could lower their credit score and maybe not prohibit, but turn out to be a higher interest rate because old data is still sitting there.
Yeah, and after a certain time period, we won't necessarily, you know, look at it. It won't affect you in the perspective of qualifying, but like you said, it will affect you in the perspective of what will your rate be, and if it is on there, most likely you're going to have a higher rate.
Right. Okay. Good. Okay.
So
people should get in touch with, and they should get to know, you know, stay in tune with your credit score, stay in tune with the credit report, make sure you know what's on it.
Exactly. Yes. And then the next thing that I like to take a look at or discuss with clients is their debts. So debt to income ratio requirements on a loan is typically around the 43% range. So the way you can calculate that is just take all of your debts, the monthly expenses. So that would be, you know, if you have a car payment and you pay $300 a month for that car payment, you would use that. If you have a credit card, so only revolving accounts would you use. So nothing like an electric bill that you pay monthly. Those are separate. So you take all of those debts and add in the mortgage that you're looking to qualify for, whatever your monthly would be, and then just divide it by your gross monthly income. That'll give you your score. So typically around 43% is a good range where you want to be. So you want to take a look at your debts to see if you even qualify with that. And student loans can be, you know, kind of a tough deal breaker in this arena, because there's tons of student loans out there, and we have to qualify with either 1% or 0.5% of your total student loan.
Yeah. Okay. Yeah, I knew it counted, but I wasn't sure to what extent. But it's basically, you know, if someone's keeping up on the credit scores and they're wanting to make a purchase, they can kind of go through some of this on their own initially, just to say, hey, so this is my debt to income. Okay. This is my credit score. Take the lower of that center. Okay. And so, I have student debt. I don't have student debt. So that can kind of give them some ideas of, yeah, financially I'm ready versus, maybe not. I always recommend people contact you. You know, it's important that they go ahead and talk to a lender. And if this is the right time for them to make a purchase, then you need to go through those next steps, which is talking to a lender, getting the credit score pulled so they can kind of gather all your data.
Yes, exactly. And we know those, you know, key questions to ask as far as your debt to income ratios, as far as your credit. You know, we're going to be asking those upfront questions just to make sure that you will qualify with, you know, everything that we kind of go over. So those are two of the main things that we do discuss during an initial consultation would be, you know, where is your credit score at? Have you, you know, do you have any collections or any derogatory accounts? We're going to want to talk about your debts, your current debts, and if you plan to obtain any new ones. So let's say your vehicle is maybe going down and you know you're going to have to purchase a new car. That's something you're going to want to talk to a lender about, because that can, actually completely turn your debt to income ratio to where you now don't qualify because you don't meet that, ratio for a certain home, of course. So because we can lower the home price, you just might not be able to purchase the house that you're looking at. And so if you talk to us first, it helps.
Yes, absolutely. And it's funny because you mentioned that once people are in contract, and one of the things I say to them, yes, you've talked to Trisha, you've gotten pre-approved, now you found the house, you're under contract. Your credit will be pulled again just prior to closing. So do not take out a new credit card. Do not take out revolving credit. Don't go buy that truck. Don't go buy the living room furniture or family room furniture, whatever it is. No, you can't do that. You have to wait till after closing.
Yes, and we need to know up front if that is the case so that we can check to see that you'll still be okay even incurring that debt. So on a conventional loan, you will have your credit pulled before closing. It's a soft pull. So you have your initial and then you have that soft pull. On an FHA, they typically do not repull your credit unless your credit is going to expire. So typically you have about 180 days for your credit report to find a home and purchase a home before they'll pull you again. And then on conventional, that's when you're going to see that second pull. So same thing with the other loan types as well. So you want to make sure that we have all that information up front, because I have seen loans, completely fall apart just because someone said, oh, well, we already went through the mortgage process, we're approved, and they go and buy a car. And that completely throws everything, off as far as the ratios go. And you basically have to start all over again.
No, that's unfortunate. I had a builder not too long ago had that conversation with me, not about one of my clients. It was about a house that was a fall through, and it's under contract and fell through. And they said because when it was time for them to get closing and they had to pull credit again, they made some purchases and now they did not qualify for that house any longer, that loan. So yeah, I try to be very competitive. Yeah.
And credit cards. Like, people don't realize, like, even if you start to add things onto your credit cards, and if your monthly payment changes, then that can even throw your ratios off. So you have to be very careful. So I typically say, if you can just hold off on your credit, on pulling any credit, on opening any, major accounts, on spending try to keep your credit card very minimal if you use it at all, just while you're going through that process so that you don't end up running into any snags like later on.
It's funny, real quick, I'll let you know, we had a physician, this is going back 2, 3, 4, 5 years ago, and he was buying a good sized house. And then it was over Thanksgiving, or what do you call the day after Thanksgiving? The big sale day before Christmas.
Black Friday?
Black Friday. So the next time I had talked to him, he says, yeah, we bought TVs for every room. It's like, wait. You did what? After we had the conversation, you did what? He says, don't worry, I paid cash. I paid cash for everything. So I was okay. Because they had big screen TVs. It's like 5 or 6 of them. So I'm thinking,
oh my,
1,000, whatever it was. So yeah, he paid cash. So I was more thankful for that.
Well, and believe it or not, that can even throw some of the borrowers off as well, just because that's kind of my next topic, is like the down payment, closing costs, having reserves, things along those lines. But before I jump into that, the last thing as far as your credit goes is you also want to kind of know that there's seasoning periods for things like bankruptcies and foreclosures. Sure. You've had a short sale. Every loan type will have a different requirement. And then we'll also be in combination with your credit profile. So let's say you had a foreclosure, FHA requires 3 years from the dismissal date of that before, or the final date of that for you to qualify. But let's say your credit score maybe necessarily isn't quite where it needs to be, then that can actually cause, a denial as far as the loan goes. So it's in combination. So you have to have the credit as well as meeting the guidelines for the seasoning period, as well as the next thing that we're going to discuss, which is your down payment, your closing costs, and your reserves.
Okay, so my mind always takes me to down payment. So I'm glad you're talking about this because there's closing costs, but there's down payment. So people sometimes get confused, especially when you have a new home buyer who doesn't know the processes, and we'd like to help and step them through the processes every step of the way. So yeah, let's talk about that. That's important.
Yeah, so after you've taken into account, I'm sorry about the noise in the back, they're scratching to try to get in here. After you've taken into account your credit, you've got all of those things. You also want to make sure that there's no back taxes. You don't have any liens that are currently out there. No derogatory federal credit debt, like you're not behind on your student loans, because that'll affect you as well. Mm-hmm. You're going to want to take a look at that down payment, closing costs, and those reserves. So sometimes people put these into the same bucket, like your down payment and your closing costs. They automatically assume that they go together, but they're actually two separate items. So the first thing that you'll want to see is, well, what type of loan am I going to qualify for? And let's say if you're looking at a conventional loan, your down payment requirement minimum on a conventional loan is 5%. Unless you're a first-time home buyer. A first-time home buyer can qualify for all the way down to 3%. So that's just conventional, and then that's where we typically will see, the 20% down that people will also utilize. But knowing that every loan type is going to have a different down payment requirement is essential, because a loan program like FHA, for example, is 3.5% is your minimum, but it's required by the borrower to be paid no matter what. Whereas a conventional loan, you can get a gift towards your down payment. Let's say your family wants to, help you. They can actually provide a gift to cover some of your closing expenses. And there's different limits for each program. So FHA would require your down payment to be paid by you no matter what. However, they would allow a gift for your closing costs. So that's why they're two separate buckets. So your closing costs are the next thing you're going to want to take a look at, and that's going to vary by home. But knowing an average purchase price and average monthly that you'd like to spend will help you to also be able to break down, well, what will this loan actually cost me in addition to my down payment? And do I have that set aside? Right. As well as having reserves. Potentially, that's another thing that we run into is our underwriting system may come back and say, well, this loan requires that they have 2 months worth of their mortgage payment on reserve after closing. So that means after you paid your down payment, after you paid your closing costs, you still have to have 2 months worth of your mortgage in the bank in order for you to qualify for that loan. So that can vary. I've seen with self-employed borrowers, 6 to 12 months worth of reserves are required in the bank after you close. So that's another important factor to consider.
Absolutely. I mean, the one thing that, obviously a bank is looking out for their financial pocket, but at the same token, they're looking out for the purchaser, because nobody wants to get a buyer in a house all settled, and then all of a sudden all this whatnot happens that they now can't afford the house, and they don't have reserves, and they can't, they have nothing to fall back on. So, that's awful. We as agents, we always have conversations making sure that the buyer is ready to make a purchase and doesn't fall into that particular situation. So I'm glad that you have those systems.
Yeah, and that's where, when you were talking about the gentleman who went out and purchased the TVs and he used all cash to purchase them, well, let's say that was part of your reserves that were required, and we already verified that they were there, and now that money is gone, and that can just as easily throw, everything off again. So you have to be really, really careful with like your finances. I like to say, just keep everything kind of like calm. As you're going through the process of buying a home, try to keep it calm. Also realizing that you can't use cash on hand. So all funds have to be verified. So if you have, let's say you've been keeping your money in your mattress, and you come and you say, hey, I want to purchase a home. Oh yes, I do have that down payment. I have $3,000 in cash at home in my safe.
Yes.
We can't use that $3,000 because all funds have to be verified. So we have to verify all funds. They have to have been, in an account where they've been verified, they've been vetted, and that's the money that we can actually use, as well as any liquidable assets, things like a 401k can be used, other assets as well, but knowing that you can't just use cash on hand is also essential, because I've seen that happen as well.
Oh, Trisha, we had a few years ago, we had a listing in which the buyer was coming, and he says, I will just go to my safe deposit box to take out the cash. It's like, no, you can't do that. You cannot just go to your own safe deposit box to take that cash out to purchase a house. It has to be, I would call it seasoned, but it has to be vetted. It has to go into a bank first, acknowledge it's there, and then, then utilize that. But it's funny, I guess, until someone's gone through these processes, they don't have that understanding of how that cannot happen. How it can't work, that this has to go through certain processes, certain steps.
Yeah, exactly. And I think that a big piece of that was when we had our market crash. They set a lot of rules out there. They did a lot to protect the consumer, which is great. And in addition to knowing all of that, like your down payment, your closing costs, all of those things, the other thing that you want to take a look at is your income. So when you're thinking about your employment and what type of an employee you are will also, affect when you can actually purchase. So a W-2 employee that's a permanent, position, maybe your hourly salary, typically you're going to be okay as far as qualifying right away. If you're a self-employed contracted position or a temporary position, or you've had seasonal work, or maybe you have a bonus that you receive, all of that has a 2-year minimum requirement. So if you started a business a year ago, we are going to need to wait another year before you can actually qualify with that income. So that's another thing to think about too, is how are you paid? Are you a 1099 employee? Because now you're considered self-employed, whereas a W-2 employee, may not have that same criteria. So those are things to consider as well.
Yeah, I get that, because I know, like for us, for instance, we are considered self-employed. As realtors, we're small business owners. So we are a small business owner, self-employed type that you're referring to. So we're not counted the same as if you are working for the city or a corporation. So I understand what you're saying. We have to go through different, not channels, but we have to do it differently.
Yeah, absolutely. And then also thinking about, have you had any gaps in your employment? If there are gaps that can be explained, then that's totally acceptable for an underwriter. But if there's some major gaps, then that can actually disqualify you, and you may need to wait, at least a year to get your first tax return if you're a W-2 employee, minimum 2 years if you're self-employed. So those are things to consider, is how consistent has your income been over time?
Well, and you're going to borrow from a bank. The bank just wants to make sure you can pay back. And by all these steps that they're asking, that is just validating that, yes, you have the funds, you have the credit worthiness, etc., to borrow money, to pay back money. I mean, it's in a sense, it's almost common sense. It's almost common sense, but really, because there's so many steps involved, it's just so unknown. Most people don't know all of this until they go through the steps.
Yeah, and there's a lot. So it's, just remembering all this information would be a challenge. So that's the beauty of being able to contact a lender, even if you're thinking a year down the road. Most people plan to purchase a home. It's many years that they've been waiting or saving, or, a year before they're planning to purchase. And maybe they can qualify now and, they didn't realize it, or maybe they're needing a couple more months before they're ready to purchase. And that's kind of what we do. That's our job. So we're going to take a look at everything. We're going to look at your credit profile. We're going to look at those debt to incomes. We're going to ask you all of those questions just to make sure that you're going to qualify for that loan up front before you move on to the next step. So I always like to say, you can do both at the same time. So like, let's say you're wanting to go out and start looking at homes. that you can definitely do that. But in the same token, make sure that you're also checking in with the lender to see that you qualify. So before you get your heart set on a home that you may not be able to afford, you know exactly what you can qualify for. You're looking for homes that you are actually approved for, and then you're ready to move forward. So that's an essential step for sure.
I tell you, Trisha, that's so spot on. I always, whenever we have a buyer, we always ask if they've gone and talked to a lender to get the process started, because there's nothing worse than showing a buyer who says, "Oh yeah, I'm financially, I have this much and I can do this, so I can afford a $400,000 house." So you go showing them $400,000 houses, and it's like, okay, I want to get that house. Let me go talk to a lender. Well, now you're really only your mind was that you could afford that, but your finances is only for a $300,000 house. So all of a sudden, that poor buyer has just sunken. It's like they can't afford what they really want, what they found, what they spent their time. It could be a week or 2 weeks or 3 weeks looking for that right house. And they've wasted all that time not realizing they should be looking in a totally different bracket. So it's to me, I know there's a lot of agents out there who will take buyers out before they've gone through the process, but I think for us as agents to set the buyers up for success, their first step is to talk to a lender.
Yeah, and also it's important to know that, if you're ready or you have questions, you don't have to go through the formalities yet. You can do like a basic, skeleton of an application. Let's say you're wanting to wait to pull credit because you think there's a few things you have to work on. So you can even, talk to a lender, maybe even submit like a skeleton of an application. And then that way we can actually go through and start to see your full picture, ask you the questions, make sure that you're ready to go before you formally pull credit to then move forward into purchasing the home. So a lot of times I think that, there can be a misconception that if you call a lender, then automatically you're going to start that process. And that doesn't have to be the case. It can be an overtime, let's go ahead and talk through everything and come up with a plan and come up with a timeline and even get you there. Like we know the steps it takes to get you to where you need to be. And that is going to vary by person. And so it's so essential to just get in contact, to talk to an expert who can, talk through everything with you.
Absolutely. I love that, and then I'm going to utilize some of this information when I'm working with people that you don't actually have to get your credit pulled, but go through the softer process just with a lender, just to make sure you're going that far and you know that, yes, you can do this. And some people don't want their credit pulled right away. I get it. That brings up a question. I know people have said, I don't want my credit pulled because I just had it pulled for something else, whatever. Or actually they were going to buy a house, let's say, and some lender from up north pulled their credit. And now they decide, okay, now I'm going to move down to Florida. I don't want my credit pulled because my up north lender pulled my credit. So what's the basis of that? Because I know what I've heard. I want to make sure that what I've heard is accurate.
Yeah, so what happens is, as far as your credit score goes, you actually are allowed to shop for your lender. It's similar to when you go to purchase a vehicle. The algorithms, they're smart enough to know that you are not going to have your credit pulled, 10 times at 10 different dealerships. And so what they do is they combine that into one. Well, it's the same thing with a larger purchase like your home. You're allowed to, go to multiple lenders, have your credit pulled at each of them, as long as it falls within a 30-day time span, then that will only count against you as, one hard hit on your credit, which is nice. So then you're not feeling like, oh no, well, I'm stuck with one person. If I have my credit pulled, then, what if they don't have what I want or what I need? I'm feeling discouraged. That can happen a lot. What's nice about like Fairway, for example, we are an independent mortgage lender. So what that means is we actually work with 24 different banks and investors. So 24. When I pull your credit, I'm actually checking Wells Fargo and BB&T. I'm going through and going to each of these independent lenders as well as each of the banks that we work with to see what your rate would be. So you can find lenders that do that as well, where when you come in, you're not set in one rate because that's all I can offer you. I actually shop for you. So that's kind of nice as well.
Yeah, I love that. Because there are some that don't do that. They don't have the ability to do that. So shopping 24 different lending houses, if it's a bank, whatever, that's really important to know. It's kind of like, health or life insurance. You go to one agency, and they'll actually shop all the different insurance agencies that are out there to find the right policy at the right price for the particular home that they're going to insure. So I'm glad that you do that. That's good to know. That's good to know. Yeah. Looking at the clock, it's 31 minutes already. I know we could talk all day on this topic, and I know there's so much information to give. And this is just, coming in to make sure you're qualified. There's so many topics that we could talk about under the heading of lenders.
I know, we'll have to have me back on so I can start to share about loan options and things along those lines.
Yes, definitely we'll have to do that. Maybe once a month, do a lender spotlight type informational segment. So I'm going to go ahead and real quick, I wanted to put this up here. Before we end, I wanted to put Trisha's information up here. I wanted people to see this is what it looks like. So you can actually go to her site and apply online. Everything's virtual today. We know that. And so you don't have to go into a location to sit with somebody with a mask on to apply for a loan. You can do this on her website. Trisha, you want to give out the website address?
Yeah, so you can actually just type in my first and last name, and my team page will pull up. So it's trishabrant.com. And so when you type that in, this is the webpage that will pull up. You can apply right here by clicking that button right there. Or you can also contact me and we can actually discuss and talk personally, and I can actually, take your application over the phone as well. Either way, your initial consultation will be everything that we kind of just covered in this video. We'll kind of go over that, but for, each person personally.
That's very nice, very nice. So it's TrishaBrant.com. So TrishaBrant.com. So that's how you can directly get to her particular page. And like she said, you can contact her, give her a call. I mean, Trisha, you're great with communicating with everybody and having, answering questions and not just answering questions, but posing questions to them to make sure that there's a good understanding of what's happening, what they need to do, etc. So anybody who's watching, I know this particular video will sit evergreen on YouTube, LinkedIn, my Facebook page. Trisha, I hope you have it on your Facebook page. And Trisha, feel free to share this out, push it out to all the people so they'll be able to, go back and watch this and see some of the answers they may be looking for as well.
Yeah, and it's helpful for, realtors, it's helpful for borrowers, it's all around, it's just good information to have so that, you know where you need to be in order to move forward.
Absolutely, absolutely. So I don't want to keep everybody on. It's 34 minutes that we've been chit-chatting. So I know it's a long time, and for some people, they'll be able to watch the whole thing later on. Some people will grab segments, but I wanted to say thank you for jumping on and answering some of these questions. It was really, really great. And we'll probably have you on again next Monday. So I'll give you a call and we'll schedule what that will be for another, did I say Monday? I meant month, another month from now. And this is this is all live. It's the beauty of life. We never know what's going to happen. But yeah, I'm going to say goodbye to everybody and thank you again for being on the show. So everyone, we try and do this every Friday at 12. Different topics, different vendors, I will call them, that are all ancillary to the real estate world and home ownership. So hopefully you'll join us every week, and we'll have Trisha on in another month. So I'll say goodbye for now. Bye,
Bye
Trish.
for now. Thank you.
You're welcome. Thanks for being on.